Hello, we're going to talk about question 4 in the September-December 2021 SBR exam. Before you listen to the debrief of each part of the question, it will help if you do some planning yourself, so read it through, plan out what your thoughts are before we actually start to talk about it. So feel free to pause this as much as you need. The first requirement was about the principles of good disclosure. It was specifically the principles of good disclosure in respect of crypto assets. So it would be important to mention the word crypto assets once or twice. But to be honest, the principles of good disclosure are the principles of good disclosure. So they would apply equally to inventory, PPE, development costs, everything. It's exactly the same. So it's the same sort of arguments. No need to refer to any exhibits here. 2 bonus marks. The 2 bonus marks, one is for using headings, which would be very easy to do. The other one depends on your written style. You might get it, you might not. But we'll certainly get, or you should get, the headings mark. And then after that, it's really open marking. So in terms of this, when you're thinking about ideas, all sorts of things at the end of the day, so you would want to make sure that, again, disclosure satisfies the characteristics of financial information. So things like information that it is stuff that can be faithfully represented. It's stuff that would encourage comparability. Things that would be relevant to users. We would want to avoid over-disclosure. So really, it's probably a very standard answer, this part. But as I said before, you would want to make sure you mention the word crypto occasionally. Again, you would want to say there, again, that you would want disclosures that were specific as opposed to generic or boilerplate. So specific, not boilerplate in terms of disclosures. So all of those sorts of things would be fine. I don't think we would have too much trouble pulling out a reasonable discussion around there. Things like simple language, things like, again, avoiding information overload, making sure we just show stuff that would be material. Clearly, you'd want information about fair value of these things because they're very volatile. So that would not be a problem, the first part of the question. The second part, which was for 5 marks, in the scenario, it said that we had basically had various development and promotional costs. And it said, well, are these intangible assets? So this was in respect of development and promotional costs. So the best place to start, isn't it, is with your knowledge. So the good old definition of intangible being something that is identifiable, and then the fact that it's either separable or gives legal contractual rights. And of course, ultimately, you've got to have, with any intangible that's recognised, a probable inflow of economic benefits. Again, given the word development, I may well have talked a bit about development costs as well. I think most candidates would have kind of veered into that at some stage. So, in terms of the application, what is absolutely clear, of course, is that promotional costs are advertising. And we all know, don't we, that advertising costs cannot be capitalised. Expense. In terms of the other costs, well, not enough really information, is there? But we may be able to capitalise. They need more information. If they are able to capitalise, again, they'd have to keep a very careful eye on things like impairment. So, impairment reviews. So that, to me, looks not too bad. Couple of marks there for knowledge. Couple of marks, one for saying advertising expense, the other for saying, well, potentially you could capitalise the other. Next part of the question, part C, is of course where it starts to get a bit messier, because we've got this thing called an international coin offering. Your panic is then to say, well, I forgot to read the articles, I don't know what to say. Just be calm and say, what is it that is actually going on in this situation? Now, this was worth 6 marks in total. The first part, again, is to explain what happens with the pre-sale agreement. The pre-sale agreement, again, is in respect of the year ended 31st of March 07. And we need to look back at the scenario and see exactly what it is. So the idea is the person gives you some money, that's what it says, isn't it? Which will give them a later discount on whatever it is that's going to happen next. Fine. That's super. So they've given you that money, which seems like a deposit. And then later, it's possible that they'll get the discount. It's possible that you might have to give them their money back. That's what it says in the scenario. So if you have to possibly return the money, it sounds to me like a liability. So I think in terms of that, the key thing is to say that from the scenario, you've noticed that there is a possibility. So there we are. We don't have, again, a huge amount of information. So this is refundable if the, whatever it is, ICO is abandoned. So probably that would be seen as a liability rather than income. Though you may not at this stage have thought about whether it is income, because you may be saying, I'm still not sure what's going on. But I think we could agree, and that would be an easy point to make, this looks a bit like a liability. Again, if you've gone down the route of saying, well, it's like deferred income or contract liability, it's okay. You're certainly arguing around the right lines. Then we've got the 10 million, so debit cash credit liability so far. The 10 million that's raised. So, and this is in the year ended 31st of March 08. So some people give me 10 million. Okay, sounds good to me. So let's think about some knowledge and then apply it. I think half of you will be saying, well, I wouldn't give 10 million for this, neither would I. So they've done it anyway. They've done it. They've given us the 10 million. So let's have a look here. So the first thing is you say, well, if someone gives you money, perhaps they're buying shares. So the knowledge is equity. Definition of equity is residual interest in the assets after liabilities have been deducted. It says a couple of times in the scenario, there is no residual interest. So therefore, it's not equity. Okay, so it's not equity. So what else could it be? Well, it might be, conceptually, a financial liability. So what's the definition of that? You know that. It's a contractual obligation to deliver cash. So, is it a contractual obligation to give the other person some money back? Again, the holders have no rights to redemption. So again, there are apparently no redemption rights. It's not a liability. Think back to when you first learned double entry bookkeeping. You debit cash, what's a credit? The credit is an increase in equity, no. Increase in liability, no. Or income. So is it income? Well, you haven't got to give them the money back. I can't think of anything else that it is. So given that it's not equity and it's not a financial liability, I think we struggle because you're saying, well, who are these people that you can find? I wish I could find someone to give me 10 million. I'd love it, you're saying. And then I could have income. Well, you didn't. They did in this question. Tough sausage. So if it's not equity and it's not liability, we therefore say, well, therefore, the 10 million means that you have got an increase in your resources. Marvellous. An increase in resources of the company. It's income. It goes to the profit and loss. You know, every bone in my body says, well, surely the police should come round and make them give it back. No, it's the deal. That's what the deal that they've done. So that can go into the profit and loss. It does say that there's a commitment to pay 10% of profits in the future. Now, is that a dividend? Well, it's not shares. Is it? It's. I guess it's closer to a liability. So this commitment, because they might not make any profits, but it sounds to me like they're doing well. So the commitment to pay the 10% of any profits, I guess I would visualize that as a liability. Or, of course, if it's only going to be something that's possible, not probable, then I suppose it would be something that would be a contingent liability. Best we can do, but that's all that actually asking us to think about. And there's that part of the question. Then we come to the last part of the question, where the directors have been given some special tokens, or the employees, the tokens for the directors. So this is that last requirement there, requirement D. Again, it's 6 marks. So, in respect of the tokens for the directors, then what's happening here? They apparently can later swap these things again for cars. So they can get a car again of their choice up to $50,000 if they stay in the business. And the question is saying, why are these things employee benefits as opposed to share-based pay? So let's think about both. Is it share-based pay, IFRS 2? Well, what's my knowledge? Is that share-based pay means that the pay is somehow linked to the share price. So the pay is somehow linked to the share price. That's what share price-based pay means. This is not about shares, is it? There are no shares mentioned in here. So there are no shares involved in this transaction. Therefore, that means this is not share-based pay. What is it then? Well, if you give a company car to a director, something in your mind says, doesn't it? I think it's just employee benefits. Now, IAS 19 is not just about pensions, it's about ordinary short-term benefits as well. In which case, the standard doesn't say much, except to say, well, you just account for them normally. So, employee benefits, that's the other one. Well, do the employees benefit? I think so. So at the end of the day, really we can say that this car allowance, or whatever you want to call it, again, is really very similar, or part of, directors' remuneration. Either way, the company is going to have to fork out $50,000 per director, because I guess the petrol station, whoever sells you the car, they're not going to take your funny tokens, are they? So I guess we'll want some money for that. So I think that's a proper cash cost. So I think there will be an employee expense over the next year. That employee expense, $250K. That's 5 lots of 50,000. And there we are. There's question 4. Easy question or hard question? It's hard. Of course it's hard. But we get the marks to pass by trying not to panic. Where were the easy marks? Well, the start was easy, wasn't it? Principles of good disclosure we should be able to deal with. Advertising costs, definition of intangible, should be fine. Pre-sale agreement you'll have got right. The bit here though, I guess this is about 4 marks worth, saying, is this 10 million equity or financial liability? You've probably got the definitions down but then got stuck, so we'd get a couple of marks there. On the last part, I think you would probably have clicked, it just sounds like director's pay, and therefore it just needs to go through the P&L. I needed to say there, didn't I, in the profit and loss. Hope you found that debrief useful, but there's a review of question 4 in the September-December exam. As always, thank you for listening.